There are these two words we use over and over again to define the perfect business for us to lend to. And those two words are stable and boring. There's no hockey stick projections. Slow, stable businesses do two things really well. To pay your interest, they amortize your debt.
Ron, thanks so much for joining me.
Thanks, Ted. Thanks for having me. I appreciate it.
Why don't you take me back to your very first job?
When I graduated college, I went to work as a systems engineer for a company called Electronic Data Systems, EDS. EDS was Ross Perot's company, and it was a technology company that provided IT facilities management and business process outsourcing to companies across a wide variety of industry sectors. And the model was one where you co-located with your clients. So when I got out of the systems engineer training program, I was positioned at a regional bank on the East Coast. By the end of 3 years, what I'd figured out is I was much more interested in the finance side than I was the technology side. And so I decided, to try to make a change. But, without the benefit of sort of traditional finance training prior to that, it was very difficult to move into investment banking. And so I decided to go back and get an MBA. And at the time, the two best schools, if you wanted to focus on finance, were Wharton and the University of Chicago. And I was fortunate enough to have the opportunity to choose between the two. And I decided to go to the University of Chicago, mostly because I'd lived on the East Coast for my entire life. And absolutely loved it there. You got to study literally with legends in finance, guys like Merton Miller and Eugene Fama. These were the guys who actually wrote corporate finance theory. And I had a great 2 years there. And then when I graduated, I got a job at Chase Manhattan Bank in the leverage finance business. So I'd made the transition. But while I was in the training program, Chase sort of went through a little bit of a restructuring, and they combined three groups. They combined the leverage finance group, which was the traditional acquisition finance business that we all think of when we think of banks, with their mezzanine finance group and their equity investment group. And we rebranded it Chase Merchant Banking. And so for somebody, really learning their skill, it was a really unique opportunity, because not only were you tasked with evaluating companies, taking them apart, figuring out if they were, investable, but at the same time, you were looking at them across different types of assets where you could invest. So you had to think about relative value, risk-adjusted return, really think about these businesses, not just from a credit perspective, but from an investor perspective. And for me, it was a wonderful education process, and it's informed my investment, process and methodology for the rest of my career.
When you had that breadth of looking across the capital stack, a lot of different businesses, what did you find most resonated for you in the types of investments that you kind of just were most drawn to?
Maybe it's part personality, maybe it's part going through, an intense credit training regimen. But, we support private equity, right? And there's a very different risk when you're a private equity investor than when you are a senior debt lender. And, what was unique about this opportunity is we could pick our spots. We could decide, we don't want to lend senior here. We're going to do junior capital. We're going to do mezzanine. We're going to do equity. But I think, for me, I've always I sort of live with when I make an investment, I want to be able to sleep at night and not worry about it. What types of businesses did I tend to sort of lean in on? The stable businesses, the businesses that were predictable, were less volatile, the businesses that really sort of more lent themselves to traditional senior debt lending.
What were some of the sort of landmarks of your time at Chase and since leading up to when you joined Invesco?
I spent about 6 years at Chase and worked with some really great people, and many of whom are not just friends today, but many of whom run private equity firms that are my clients today. But for me, I found my way into a really unique opportunity, about 6-7 years, post my time at Chase. And I was offered the opportunity to go build for the Royal Bank of Scotland, a middle market leverage finance business focused on private equity. Nobody knew what RBS was in the US. But if you actually looked at the bank, it was the 5th largest bank in the world by market cap. It was this huge bank. And perhaps more importantly, they were the dominant provider of acquisition capital in Europe. And so you had this huge bank that had decided that they wanted to come into the US and replicate what they'd done in Europe in the US. And it was absolutely fantastic. And so for me, I built out sponsor coverage, execution, portfolio management, sector expertise and distribution. And over a period of 5 or 6 years, we built that business to be one of the leading middle market providers in the US. It was a wonderful time to be in the business. Unfortunately, all good things come to an end. And, when the GFC hit, RBS felt pretty hard, like many other banks across the globe. But I think in the case of RBS in particular, what exacerbated the challenges for them is they had just bought ABN AMRO the prior year in a competitive process with an all-cash market-topping bid. And so when the GFC hit, for RBS, the consequences were pretty significant. And the bank went through a restructuring whereby they created two banks. They created what they called the core bank and the non-core bank. And the non-core bank at RBS housed all the highly structured assets. They weren't necessarily bad performing assets, but they were the assets that required significant regulatory capital, the capital with which the bank didn't have. And I was put in charge of the non-core bank in the US, which was about a $30 billion vehicle. And my task was to figure out how to liquidate and monetize those assets so I could return capital to the core bank to sort of, fix the balance sheet. And it's interesting, it was during those times that I got my first exposure to private credit. I would get calls from platforms. I hadn't heard of many of these, but they always had sort of a similar theme. We've raised a lot of capital. We're here to help you solve your problem. Solve your problem defined as we'd love to buy your assets at 50 or 60 cents on the dollar. But for me, what I discovered in the process is that, you had some very, very sophisticated investors who had managed to accumulate significant pools of capital. They weren't burdened by a lot of the regulatory dynamics that the banks were now suffering from. And, it just became very obvious at an early point that, that this was where the market was going. And of course, back then, we called it shadow banking, and then we called it non-banking, and then ultimately we landed on the more eloquent direct lending. But just to finish the story and answer your question, so after I did what I could to help sort of bring that non-core bank down and shore up the balance sheet at RBS, I decided it was time to move to the shadow banking or the non-banking side of the market. And I took a position at a opportunistic credit platform that was looking to expand into more traditional direct lending, covering private equity firms, et cetera. And I spent a handful of years there helping them build it out. But for me, I sort of had the itch. I wanted to get back to build something myself. And then that brings me to Invesco. I got a call from Scott Baskin, who runs Invesco's Private Credit Platform, which today is about a $50 billion credit platform. At the time, Scott was running a series of strategies within that platform, and was interested in thinking about whether he could leverage that platform into direct lending. And, he and I had known each other over the years. And so, I remember we had this breakfast where really at that time, it was as much he was just trying to understand what I thought it would take for Invesco to break into this space. And after back and forth for probably about 6 months, I made the decision to go build it. And that's about just a little bit less than 8 years ago at this point.
What was the attractiveness of doing this at Invesco?
It starts with big institution, right? At the time, we were a mere $1 trillion asset manager. I think today we're approaching 2. We had a really large private credit platform. We understood the asset class, and I think the private credit platform at that point had been in existence for 20, 25 years. So we were known in the industry. Invesco has great brand recognition, and importantly, the infrastructure was in place. And when I looked at it, when I thought about what it would take for me to build a successful direct lending platform, one of the key things that I believe you must have is you have to have sector expertise. The beauty of this platform that had been built was they had one of the largest private side sector teams in the market. We have 22 dedicated sector research analysts who do nothing all day but focus within their dedicated sector on everything today, from distressed to liquid to direct. And so for me, as I thought about coming in, I could build the origination execution team, and we would have we could leverage off this built-in wealth of knowledge, IP, existence via existing portfolio companies and experience across all the sectors that we had built. And so I came on board. I brought a handful of my partners from RBS, all of whom are with me today. These are all great sponsor coverage folks with tremendous, credit skills. And we sort of, We put the business in place, and it was sort of as if we'd never stopped working together. And we sort of called up all of our old relationships and just sort of picked up the business right where we left off.
I'd love to take a step back and talk some about direct lending as an asset class.
Yes.
Hear a lot more about it now. You've been at it really for the whole time. What are some of the things you've seen in changes and evolution of this sort of sub part of the market?
I often get asked, well, this is a pretty new asset class. How do you think it's going to perform, if the market cycles, things like that? And to that, I always say, it's not a new asset class. What has changed is the constituency that provide those capital solutions, right? So if you go back before the GFC, this was, middle market finance was the purview of banks. They dominated it. They were great at it. They had tremendous relationships. And post the GFC, when the OCC leveraged lending guidelines came in place and Basel III was put in place, the intent of those regulations was to make it more difficult and more expensive for banks to participate in that asset class. And so what you saw happen was simply a shift in the providers of that capital from the regulated banking side to the non-regulated, private capital providers. The reason for that is when you think about the world we live in today, the volatility in the markets, this is an asset class that across cycles has demonstrated stability, consistency, low default experience, and I think initially was treated as a nice asset hedge for investors across a more liquid portfolio. But as the asset has grown, it's become just a key component in many individuals and many entities' portfolios.
How has the nature of the capital providers and competition changed within that? So you have the movement from the banks to asset managers. What's happened in the market for lending among the asset managers?
Post the GFC, your direct lending, I would say for the first 10 years was singularly focused in the middle market, right? The banks were still doing the large syndicated deals. There was this huge gap in the market to be able to provide, capital to middle market sponsors, middle market companies. And you started to see capital come in, and it was very successful. If you look at the entities that were dominant in the middle market 10, 15 years ago, they don't play in the middle market anymore. And it's simply a function of the fact that as their AUM, as their capital base has grown, deployment pressures have become so significant that they've had to find more efficient ways to deploy that capital. And so the evolution of this market is, whereas maybe for the first 5, 10 years, it was predominantly focused in the middle market, when we now talk about direct lending, we sort of talk about the core middle market and we talk about the large end of direct lending. And the large end of direct lending today is probably comprised of 8 or 10 huge, very sophisticated direct lenders who are managing massive sums of capital and don't spend any time worrying about the middle market because it just doesn't work for them. And instead what they've done is they've set their sights on the banks. And so what you see, I remember the first couple of times we would hear about a $1 billion unitranche, and everybody scratched their head and go, oh my God, how are they going to do that? Today, $1 billion unitranches there's nothing unique about them. $5 billion unitranche deals are getting done. And so I think the evolution of the market, I think the market's just gotten bigger, and you've just seen, as more capital has come in, you've just seen the bigger players continue to accumulate significant pools of capital and push on the wider end of the market.
So did you talk about those differences between a direct deal and a syndicated deal, some of the advantages of direct? What do you see as the distinctions in the two?
What is a syndicated deal? A borrower or a sponsor hires a bank, right? A bank puts together documentation, goes to market, figures out what they think the structure should look like, and then they go out and they syndicate that deal. And sometimes they'll commit to it, and sometimes they'll do it on a best efforts basis, but they'll give the counterparty an indication what they think the deal is going to look like. They run a bank meeting, they go to the rating agencies, and ultimately, if they're successful, they'll syndicate, they'll sell that deal down, and they'll bring in, depending upon the size of the deal, 5, 10, 20, even 50 participants into that transaction. It takes time, and it is, in most cases, beholden upon where the market says it's going to clear. Now, you contrast that with a direct lending deal in the large end of the market. You will have one counterparty sit across the table from the sponsor or the borrower, and they'll say, I'll tell you what, I'll do your deal. $2 billion, you're done at SOFR plus 6, right? Here are the terms. I don't have to go to the rating agency. I don't have to sell it to anybody else. I'll get it done next month, not in 3 months. You have certainty and you're done. Now, for that, you'll pay a premium, But at the end of the day, if you're the borrower, you know who your counterparty is going to be. And it's not just the efficiency of getting the deal done, but look, banks are required to, they have lots of regulations, lots of boxes that they have to neatly fit their deals within. When you're dealing with direct lending, they have the flexibility to be, more sort of pro-business thinking, and they can move with the companies, they can be more responsive. And so I think it is, but for pricing, and it costs a little bit more to do direct lending, it is a competitive offering relative to sort of the traditional syndicated bank.
And as you look at the universe of sponsored companies and just industrial companies that aren't owned by a private equity sponsor, what are some of the subtle differences between the two?
Today, I would say at least 70% of all direct lending is sponsored. So why is that, and what are the differences? Well, sponsored by its nature, means you're working with a private equity firm, a private equity sponsor. And the attraction of doing deals with private equity sponsors is, number one, they bring governance, they bring sector expertise, they bring best practices, and most importantly, they invest significant sums of equity in these businesses in front of your debt. Typically, loan to values today are running in the mid 40s. If you're aligning with some of whom you think are the smarter private equity investors, in the U.S., and you're lending senior secured debt, they're providing more than half the value of these businesses in first loss equity. And so when you think about it from a risk perspective, things have to go pretty bad before your senior secured loan, starts to, be at risk for being impaired. And typically what happens when you work with a sponsor, if a company does have some type of operating performance challenges, unless these are, truly, dynamics where the business is permanently impaired, your sponsor is going to come up with a solution because they've got to protect their significant investment. Now you contrast that with a non-sponsored deal, so you're typically you're dealing with private companies, family-owned businesses. There is no equity coming in beneath you. There is no private equity firm sort of providing oversight. You are the lender. And if something goes wrong, you are the entity that's got to fix it, that's got to solve it. So why would you do that? Well, there's a couple of reasons. You do that, number one, because you're probably going to get a better return, because you're not facing off against a very sophisticated private equity investor who's very, very savvy in terms of exactly what terms are clearing in the market and how to negotiate that. And equally, you're probably structuring your deals, you're probably getting a tighter document, right? Perhaps leverage is a little bit lower, the terms are a little bit tighter. And so, I think I've done both in my career. They're very different. I think there's opportunity for both, but certainly from my perspective and from our perspective, from a risk, when we think about risk and we think about capital preservation, we love doing deals, with private equity firms. We love firms that we love to partner with firms that we've known forever. We know how they're going to behave when things don't necessarily go according to plan. And again, for us, it's all about risk mitigation. But the opportunity to pursue non-sponsored deals, in the market is significant. And for the right type of investor, you can do very well there. You just need to make sure you've got the resources to be able to support it if things don't go well, and that can be very resource intensive.
I'd love to talk about the risk reward of the senior loan. You mentioned earlier in your career, there were senior loans and there were mezz loans and there were junior loans, and you had converts and you had everything in the capital stack, which seems to have evolved to more these big unitranche deals. How have you thought about the benefits and drawbacks of just playing in the senior space when that part of the capital stack has gotten to some extent simplified, but also bigger?
Earlier in my career, it was usually the case when you structured a middle market deal that you would have this first lien tranche, you would see this mezzanine tranche, and then you'd have the equity. But and again, I know I said something to this effect earlier, but markets are really efficient, and so you started to see lenders come in, private capital lenders, and they look at this, they say, well, you've got a senior piece, maybe that's priced, back then it was LIBOR, maybe that's priced at LIBOR 4, and you've got a mezzanine piece that's fixed at 12%, and it's got, a warrant or an equity kicker associated with it. I'll tell you what, I'll just blend those prices. I'll give you one tranche, the unitranche, and you, borrower, don't have to deal with intercreditor, don't have to deal with multiple parties. I can be more, it's just efficiencies of the market. And so it started there. And then it became, quite obvious that, and if you were a mezzanine lender, it was a challenge because suddenly your asset wasn't as valuable anymore because once we moved away from banks, we had the ability to sort of take leverage beyond sort of the traditional 3 times leverage thresholds maybe that a bank would think about. It's just about competitive forces by the nature of the market opportunity and some really sophisticated investors in the market. We started to see that fade away. What's interesting though, at points in time, you've sort of seen it cycle back in different ways. There's, you've got some banks now that will provide something called a first loss, tranche within a unitranche. So it's sort of almost reverse engineering that first lien, second lien, but we still call it a uni, but there's a separate agreement called the agreement amongst lenders where the bank will say, I'll take the first turn of leverage, and in return for that, I will take a lower spread relative to what the borrower thinks. You take the incremental, but I'm first loss on that first turn. So it's there's lots of different ways to cut it, but I think what ultimately has driven this change is just the amount of capital coming into the market and the desire for current yield. And again, the fact that just if you look historically at the performance of this asset class across cycles, it's just been fairly compelling. And when you look at default rates and loan loss, while you might expect them to be worse, they've continued to demonstrate, time and time again, resilience. And so it's been a difficult market to play in middle market, or to play in mezzanine, unless you're playing really at the smaller end of the market where maybe it's not as common.
So you bring all these forces together, you have to set out an investment strategy. Where did you come out and say, okay, this is the strategy that we're going to pursue here?
When I joined Invesco, I put a lot of thought behind this because when I joined, we were in a benign interest rate environment. Skies were blue. Nothing was going wrong. Lenders were being fairly aggressive in terms of how they were approaching, opportunities. And we looked at the investor base at Invesco. We looked at what Invesco had done across the private credit platform. We decided out of the blocks to skew very much towards the conservative end of direct lending. And so what did that mean? So structure, it starts with structure. We said everything we're gonna do is gonna be senior secured. First lien, unitranche. We're not doing second lien, we're not doing mezzanine. We're gonna be top of the cap stack. We're gonna have our money attached to $1.1. We're gonna have full collateral and all the hard assets, all the IP of the businesses we lend to. So structurally, that's how we thought about it. The second piece of it was, we said everything we're gonna do with private equity for the reasons we talked about earlier. We want partners, folks we know, folks who are putting significant risk capital in these businesses in front of us. That's a way to mitigate risk. And then we thought about, from a sector perspective, myself, my partners, we've spent our careers in the middle market. And so it didn't even occur to us to sort of think about going up market. This is the market we knew. This is where we knew we could generate compelling returns. And so we focused on the middle market. And then the last piece of this was we really thought, it's all about asset selection. And for us, there are these 2 words we use over and over again to define the perfect business for us to lend to. And those 2 words are stable and boring. and we say that because we're not equity investors, right? If you show me a business that's projecting 15% top line growth and 500 basis points margin improvement, I'm going to guess there's inherent risks in that are just not going to be consistent with our philosophy of sort of sleeping at night and knowing that, capital preservation is at the top of the list. And so for us, we look for businesses that have long historic track records. When you think about modeling out what that business is expected to do over the next 5 years, there's no hockey stick projections. Slow, stable businesses do 2 things really well: to pay your interest, to amortize your debt. And, the thing we talk about all the time, as a senior lender, the best you could ever hope for is to get your money back. Right? You're not supposed to lose principal when you're lending senior debt. And so everything about our philosophy was oriented around conservative structures. Everything had to have covenants associated with it. And, look, it wasn't an accident that that's the model we built, but it worked for us. This conservative model served us really well. We've come through this cycle much like we've done prior cycles, and look, no style drift. This is how we've set out to build this business. This is how we've done it for the last 7 years, and touch wood, this is how we do for the next 7 years.
You mentioned that when you came here, there was within Invesco these sector coverage with deep expertise, and you had to build out the origination. How did you go about, or how have you built out the sourcing of these opportunities in the private markets?
First component is, again, I brought with me my three senior partners that I'd worked with, literally for the past 20 years. And so between the four of us, we had built businesses together. We built them both on banking platforms and we built them on non-banking platforms. So, not only do we know how to do this, but we had a fairly broad base of sort of core sponsors that we knew we could rely upon. The second element of this, and again, this was, I guess I should have mentioned this earlier, but this was the other really attractive dynamic as relates to our coming onto the Invesco platform. Across the Invesco Private Credit Platform, we have over $25 billion of capital invested in the portfolio companies of more than 200 private equity firms. So there was already, more than just name recognition, tremendous connectivity with, a wide swath of private equity firms, many of whom crossed both, broadly syndicated and what we were doing in the middle market. In many cases, the named partner at these private equity firms was an associate when we were associates 25 years ago. So there's history there. And look, as long as you treat these relationships like partnerships and understand their needs and can address those, you should have an annuity of opportunities across a fairly wide base of them.
What does a typical diligence process on a deal look like?
It's deep and extensive. So, look, again, it starts with our simple premise. We're lending senior debt, you should not lose money. So the way we think about it, everything we do needs to be primary diligence. If we were to get a call from another direct lender who said, hey, we've closed the deal, right? And you know what, we're long $50 million. Would you guys, we'll send you our IC memo. Would you guys want to buy it? Not for any reason other than that's just not how we conduct business. We would gratefully say thanks, but no thanks. For us, everything needs to be primary. So what does that mean? It means we fly down to the company. We want to look management in the eye. We're going to do our own forensic diligence around the accounting. We're going to go deep into, quality of earnings. We're going to engage our own third-party sector experts to sort of make sure we understand all the subtleties around the business. It's a very, very extensive process. It's not dissimilar to what private equity are doing, right? And again, I don't want to, one of the sort of subtle delineations between what we do on the direct lending side and what's historically done on the syndication side is, if you're in the banking market and you're syndicating, you're doing your diligence, but your intent is to sell the business, right? So if you do it right, you risk off pretty quickly. We're going to be in this deal for 3, 4, 5 years. And so the amount of analysis and diligence we're going to do is pretty extensive. And we're going to want to drive documentation. We sort of have this, theme, which is you can find the best business in the world, but you can blow the investment on the documentation, right? And so, if you think about I've talked about covenants, throughout this discussion. You think about a leverage covenant, debt to EBITDA. If the definition of EBITDA in a credit agreement is 2 pages long. And so if you get that definition wrong, what is, the covenant may be toothless. And so everything from start to finish for us is hands-on, primary. A typical deal will take us anywhere from 2 to 3 months from start to finish to get it done.
What are some examples of things that you thought were going to be a deal you're going to be happy to lend to, and you found something that had it fall away?
What typically happens when you start a process is you'll get a SIM. It's a document that sort of sells you on the deal, right? And it's written by a sell side banker, and so it's generally pretty positive. And so you'll look at this business and you'll say, revenue grew nicely and EBITDA grew nicely, and gee, it's really conservative. The ask on leverage is pretty conservative, and so you start out thinking this could be a really nice business. I think most often, where we sort of walk away from something is, there's this thing called quality of earnings, which is, there are all sorts of, to my point earlier about definitions of EBITDA, there are all sorts of adjustments that go into EBITDA, right? I'll give you an example. I'll pick the gym business as an example. If a sponsor's buying a gym, they will ask, look, when we first break ground on a box, we spend money on it, we may want pro forma adjustments to reflect the EBITDA of that box when it becomes mature. And we say, well, that's great, but today it's doing 0, right? So for us, as we go through our diligence process and we go through the quality of earnings, you start looking at all the adjustments. This is what they're telling you EBITDA is. What was EBITDA? And in many cases, and it's always a primary discussion for us in any of our credit meetings. What do the adjustments look like? And all too often, what you discover is, the actual EBITDA is materially less than what's being portrayed. And sometimes those adjustments are legitimate, but other times they're not. And so I think for us, most often, we'll look at something and optically it'll look great, but when we start digging through the numbers and we start understanding what's happening, pretty quickly we'll sort of back away. And I think the trick to this business, we probably see 500 opportunities a year, and we do a very, very small fraction of those. The trick to this business, you got to triage. You certainly can't spend time on 500 deals. Like you've got to be able to pretty quickly figure out which ones you're just going to let go and where you're going to spend time.
When a sponsor that you have a relationship with is doing a new deal, you have this balance of you want to be accommodative, you want to be relationship. You also want to win the deal in a competitive market. How do you navigate that?
Competition, is a fact of life in our business, right? So much capital has come into the market. Whether you're looking at the middle market, whether you're looking at the upper end of the market, there are a lot of participants and it's competitive. I think there's a subtle difference, though, between the competitive dynamics in the middle market relative to the upper end of the market. And if you look at the middle market, the word you'll often hear used is clubby. Right? And what does that mean? It means I can tell you this, on every deal, with maybe the exception of one or two, on every deal we do, we will partner up with one or two other direct lenders. I like doing that for a variety of reasons. Number one, we know most of the other middle market direct lenders because we've all been in the business so long. In many cases, we worked together earlier in our careers at banks. But equally, it's never a bad thing to have more eyes looking at the same transaction and looking at it each with your own unique vantage point, as a means to sort of make sure you mitigate risk. But the point on competition is one where, you're not really incented to be too aggressive, where it comes to things like rates. Because at the end of the day, what I want to do is lead every deal I can. But if you think about your private equity clients, they may have two or three direct lenders that are their core relationships. And so they're going to rotate you, right? Invesco, you're going to lead this deal. Invesco, you're not going to lead the next deal, but we still want you in the deal. So none of us are really incented to sort of go in there with aggressive pricing, because even if you win, you lose, right? We're all going to be in the deal regardless. And so you compete on things like relationship, you compete on things like sector expertise, you compete, by trying to, bring them ideas, value add. But, generally speaking, we're all fairly regimented when it comes to thinking about things like leverage and pricing. I find it to be much more of a collaborative market relative to the upper end of the market. And I don't mean in any way to disparage the upper end of the market, but it's just much more intense. You have huge players, all vying for really, really significant positions, competing not only with each other, but also with banks. The middle market, the word it is much more collaborative. Most of our competitors are our friends. We know them. And so, we've all been doing this a long time. So, you treat everybody with integrity, you be transparent with them, and over the long term, it tends to work out. If we win a lead, we'll invite a couple of lenders in and they'll reciprocate when they win a lead. So it's sort of this, you're not really incented to sort of do silly things to win business. And there are always going to be exceptions. And when we see those, we just, we walk. We have a bit of a life's too short philosophy.
Once you're in a loan, a company and a sponsor, you think about two different scenarios. One is everything's going fine. Maybe you have to monitor it. And the other is something's not going well. And I'd love to get a better understanding of what you're doing in each of those two scenarios.
One of the nice things about the middle market is you have tremendous transparency in terms of performance. And what I mean by that, in almost every deal, we get monthly reporting, we get quarterly reporting. Because we have covenants, we get compliance certificates, we get annual budgets. And because these are small deals, we know the management team, we know the sponsor. And so every month, our analysts take those monthly numbers and they spread them. So it starts right there. And if anything sort of doesn't seem right, they'll raise it to the deal captain and, we'll look at it and, usually it's nothing, but if there's something we don't understand, we'll pick up the phone, call the sponsor, call the CEO. On a quarterly basis, we do We take the whole team goes offsite for a day and we do a fulsome quarterly review of the entire portfolio. And then post that, we sit with investment committee, and we walk them through any names that we think, need to be highlighted for them. And there's a fairly extensive rating system we go through. All of which to say, it is rare, if ever, that we're going to be caught off guard or surprised by something really bad. Because we should, if something's going wrong, if there's a trend, we should see it coming real early and we should be on top of it and we should be aware of it. Now, look, if something goes wrong, you need to have restructuring capability and resources or you're going to find yourselves in trouble. And I think for us, and again, perhaps another, I think, real attraction for me of the Invesco platform. And so on my team, we have workout resources. One of my partners ran restructuring during the GFC at the bank he was working at. And so on any deal we do, we immediately, drop him in and he becomes captain if we have a problem in a credit. But I think more important than that, across our private credit platform, we have, significant resources. We have a distress team that does nothing all day, but, focus on challenge credits, loan to own. And so there's a wealth of resources at our disposal such that if we find ourselves in a situation, you want to make sure you've got, proper resources available to be able to address it.
How do you use all of the data that comes from all these reports from companies across both your portfolio and thinking about what's going on in the markets and opportunities?
We do a fair amount of analytics and sensitivities across our portfolio. So we run, on a quarterly basis, beyond doing our portfolio management, we run all sorts of sensitivities. We look at what's going to happen if interest rates go up, what's going to happen, if margins go down. We look at it on a name-by-name basis. We look at it systemically across the portfolio. We also look at all sorts of analytics. What's happening at the top line across the portfolio? What's happening at the margin side? So I think for us, when we sit in front of investors, everybody's got the sound bites of what's going on the market. We can tell them what we think is happening, vis-a-vis our access to the middle market. And I would tell you, I think in many cases, it's a little bit of we can sort of front end what we're going to ultimately hear, because I think these companies are going to, if something's going to go wrong, we're going to see it earlier than perhaps we're going to see it across the broader market. But for us, data is important. It's the whole, the key thing for me on the portfolio management side is you just don't want to get caught by surprises. If you can get out in front of problems, if you can understand where things are going, you have a far better chance of sort of remedying them, fixing them, and sort of putting yourself in a position for a successful outcome.
Well, it's been a long time since we've had a real default cycle. Yeah. You've been through a few. Yeah. And we'd just love to get your sense of how you're thinking about the current environment in light of what you've seen in the past.
I've lived through credit cycles, market dislocations, Great Recession. And what I would tell you is every time you have a credit cycle, it's different, right? And every time you have one, nobody predicted it, or certainly nobody predicted why it happened. I think today we're living in a really unique environment, right? And we have been for the last couple of years. Like we've lived, since 2022, we've been living in this rising interest rate environment where we were worried about inflation, we were worried about recession. We had all these geopolitical conflicts. A lot of things to worry about, and in fact, it actually has had a pretty significant impact on M&A volumes and deal flow. But I think as we sit here today, and I think it suits our strategy, we live with an eye towards the glass is half empty. And so on every deal we do, we run recession scenarios, and we're very, very selective about the types of businesses that we're going to invest in, because you're looking, if you just think about where we are right now, we've been living in a higher for longer interest rate environment. We're staring in the face of, some type of tariffs. I mean, nobody actually knows where we're going to end up, but ultimately they're going to have some type of impact, on the economy. We are trying to figure out, are we going into a recession? Are we looking at stagflation? Are things going to sort of settle out? What's the Fed going to do? You can look at all these macro dynamics in the market. You can handicap them. But at the end of the day, in all those scenarios, where do you want to be in the cap structure, right? I think for us, we want to be senior secured. We want to be at the top of the capital structure. We want to have lots of capital beneath us. We want to have, full collateral in all the assets of the businesses we lend to, and we're going to be really selective about the types of businesses we lend to. So, look, if we think we're going into a recession, we're going to stay away from highly cyclical businesses. We focus a lot on the health of the consumer. We're not, leaning in on discretionary, consumer products these days. We're thinking about all the things that could possibly go wrong. And we're doing our best to either mitigate those and make the investment or not make the investment. I don't mean to sound, draconian here, because I do believe at some point we're going to find our way to the other side of this. The markets at some point will stabilize. And what's going to be really unique about this opportunity set then is, because of all the uncertainty we've been living in for the last 2 to 3 years, you've got private equity investors that are really long assets, need to sell them, but haven't been able to because buyers and sellers just haven't been able to acquiesce around valuation. But when we get to that point where markets start to stabilize, there's going to be a huge backlog of opportunities that are going to come to market. And so for us today, we're being really selective. We're keeping our powder dry. We're watching. We're all over the portfolio, but we're waiting. We're waiting because we do believe there's going to be a pretty significant opportunity coming down the pike.
Are there any signposts that you're seeing in structures of risk that maybe you've seen in the past, or things that you're staying away from, even if you are fine with the sector that it's in?
The two things that I think most simplistically are telltale signs for, are you going to get in trouble or not, are leverage and covenants. And again, I probably sound like a bit of a broken record here, but if you start to see leverage creep up, then you got to start worrying. If you start to see deals coming in our market without covenants, you should start worrying. The other thing, that I'll tell you, there is another sort of red flag in the market, and it's something you're hearing more and more about these days, and this is the advent of bringing PIK into your transactions, right? Payment in kind, right? Our deals are all done cash pay. That's the way you're supposed to do senior debt deals. And if you look at a portfolio, it should be all cash. Right now, there are going to be times when you structure a deal day one where for company-specific reasons, maybe you're going to have a PIK component. Perhaps the company's got some significant capital expenditures they need to make over the next 2 years. So you'll put some PIK in there just to give them a little bit of additional free cash flow relief. But you're doing that knowing why you're doing it. I think if there's a red flag or a canary in the coal mine, if you will, in the markets today, is if you start to see portfolios that were structured with all cash starting to suddenly show up with PIK components. Because if you're restructuring your deals where you're converting some of your current cash into PIK, you're doing it for a reason. And there's only one reason you're doing it. You're doing it because the company doesn't have the free cash flow to service your loans. And that, that's a key red flag. If I were speaking to an investor and they said, well, how do I assess, this direct lender versus that direct lender, or this portfolio versus that one of the things I would say to them is look into the portfolios. Look at what opening leverage was. Look at where current leverage is today. Look at what percentage of the deals, started out all cash and what percentage of the deals today have a PIK component. If those things have moved in the wrong direction, those should be red flags that you should just, you better dig in a little deeper.
It feels like in the private equity market, there's a little bit of the bottleneck of capital because you haven't had liquidity. And yet on the credit side, it feels like there's almost insatiable demand.
Yeah.
And what have you seen as those two come together?
There's a couple of dynamics here, right? So number one, private equity have raised, record sums of capital, right? And it's a challenge for them because, again, we spend about half our time talking to investors and the other half our time talking to our private equity clients. And, thematically what we've heard from them, and this is across the market, is it's slow. There's just not enough. They keep waiting for, deal volumes to pick up. So they're sitting on cash, and equally and problematically for them, they're not able to sell these businesses. And so, when you think about the cycle for a private equity investor of, raising money, investing in companies, improving those companies, exiting, distributing capital back to their investors and doing it again, to your point, there is a bit of a bottleneck there. And we hear it from investors all the time. We're telling us we're just not getting distributions back at the pace we had hoped. So then you pivot to the credit side, and you're right. So why is that asset class just continuing to raise more and more capital? Again, I just think it's a function of the fact that, it's a pretty attractive asset class in the environment we're living in today. You look at these equity markets, it's hard to see our equity markets, growing 10, 15% from here in the near term, just given all the vol in the markets. But if you choose to invest in this asset class and you can deploy, you're going to be sitting there generating, low double-digit returns, hopefully without a whole lot of, risk to the portfolio. But as more capital comes in, it absolutely does create more competitive pressures. We have seen these spreads come in 50, 75 basis points, but I think the reason you're still seeing so much capital coming into the market is on a relative basis, it's still an incredibly attractive asset class. We are consistently generating, low to mid double-digit returns across the cycle. That's a pretty good place to be, in almost any environment.
So you've built out this business over the last bunch of years. How do you think about growth where if you raise too much money, you'd almost take yourself out of the mid-market where you like playing?
It's a huge challenge. And it is, I could tell you throughout my career, it's always been the dynamic. The more successful you are, the more capital you raise, the harder it is to sort of continue within your strategy. Now that said, look, we have a lot of private equity investors, that have been doing this for 25 years, and they have consistently said, look, we could raise more, but we like this segment. We're sticking to the middle market. This is where we've been successful, and this is where we're going to stay. And we have a similar philosophy. I don't aspire to go bang heads, with the entities that are deploying, 5-10 billion a quarter. Like, it is a different market. It's not where my expertise lies. It's not where we have fun. It's not where our clients are. And so for us, we're just going to be really careful and measured about the capital we raise, the capital we deploy. Maybe someday it becomes a problem. I guess it's a high-class problem if it happens, but it's not something we're trying to do. For us, we would rather, one of the terms you'll often hear, when you get to a certain size, you become an asset gatherer versus an asset investor. We want to be investors. Like, we like investing. We'd have to raise a whole lot of money before that will be a problem for us. We've got a long road ahead of us in terms of making hay within the middle market.
How do you think about capital solutions for the middle market businesses? I know on the larger end, you see all different types of potential financing structures in the large alternative asset managers. You're just focused on the senior secured piece.
Yep.
How's the team thought about, there should be a different risk reward opportunity below that into the equity?
We talk a lot about it, but I think, again, for now, earlier in my career with my partners, we ran mezzanine funds. We did a lot of aggressive equity co-investing. Again, it was, somewhat a function of the market. I think for us, the path we've set ourselves on at Invesco for now certainly is to stick at the top of the cap stack. We look at our investors and we say in the context of your overall portfolio of investments, you should think about us as that very safe, secure, low double-digit opportunity. You can tuck it away. You're going to get quarterly distributions from us, and you're going to sleep well at night with respect to, what we're doing for you. And we like doing that. Is there an opportunity down the road to sort of play in different parts of the cap stack? Maybe. I think it'd be more a function of what the market opportunity looks like. For example, if we went into a significant recession and you saw valuations start to plummet, maybe there'd be a better opportunity to play at some of the junior capital and take more of the equity upside. But I think in the current environment, just sticking to our mandate, which is orienting around capital preservation, being great stewards of our investors' capital is sort of where we're gonna focus.
What's been your favorite deal that you've worked on?
I did a deal a handful of years ago. It was a fitness deal. It was a gym business. And it was the sponsor was somebody I'd known, for probably 10 or 15 years. And I remember we got in a van with the management team. And we literally drove for 2 days from, they had about 40 boxes. These were big 40,000 square foot boxes in the mid-Atlantic region. And we literally drove, from site to site, and we'd get out and you just watch the interaction, and it was, these guys were just incredible. You'd get out and he'd look at that, you got to clean the window there, or he'd go in and he'd hug, the lead trainer. And I hadn't done a gym deal prior to that. And they are really unique animals. Like when you finance the thing about gym businesses is, on average, you lose 40 to 50% of your clients every year. So it's kind of like, what business in the world would you lend to or invest in where half your clients quit every year? It's kind of a weird thing. But notwithstanding that, when you look at the macro, dynamics in the U.S., gym membership grows every year. These guys were just incredible operators, and from start to finish, I was in that business for 10 years. Through 3 financings, through multiple sponsors, and including COVID, which was for a gym business not a great environment. But these guys were great operators. They came through the other side of it, perfectly. And we actually just exited the business last year. It was sad to see it go, but it went to a large cap direct lending strategy without a covenant. And for us, that was sadly the point where we shook hands and we said goodbye. But it was, just a real fun opportunity.
And then as you go through credit by credit, how do you put your portfolios together?
To be most conservative, you got to really focus on diversification. And so for us, we look at diversification on a single name basis, diversification on a sector basis, diversification on a sponsor basis. And I would say on average, our typical investments will represent, probably somewhere in the 1% to 3% position. So across the portfolio, I'm expecting to have 40 to 50 investments. And the reason for that is, you're never gonna, you think you're doing great credits, more often than not, if you're gonna have a problem, it may not be, the credit you thought was gonna give you a problem. But as long as you diversified the portfolio enough, as long as there's no single name that can actually do any damage, even if you have something that goes sideways, it's not gonna impact the overall performance of the portfolio. And so for us, when we think about construction, it's very much focused on making sure we build a very diversified book of business across all of our funds.
How have you thought about leverage on the funds?
Leverage is it's a really interesting element, in the direct lending space, and to some extent, it's driven by investor risk tolerance. And we have some investors that very early on said, look, we don't want leverage on the vehicles, and part of the thinking was, these things are yielding, you're in the double digits, that's all we need. We don't want to take the incremental risk associated with adding leverage on top of these vehicles. And then we have other vehicles and other investors that have asked for leverage. I think for us, across all of our vehicles, even where we have leverage, we tend to skew more conservative. We won't put more than a turn of leverage on a vehicle, and you will see some direct lenders go as high as two turns of leverage on their vehicles. And look, I don't think it's a bad strategy. A turn of leverage, will generally afford you somewhere in the neighborhood of 300 basis points plus of incremental yield. So it's not inconsequential. Of course, the problem with leverage is the obvious one. If things go wrong, you've leveraged the negative. So, again, for us, we look to our investors. Some want it, and we're happy to provide it, and many don't. And, look, for us, look, I don't worry about it in the context of our portfolios, because I know what's in those portfolios. I know how we're selecting those assets. But for us, the investor drives that decision, and we'll accommodate them either way, whether they want it or not.
We're going to circle back to bank involvement. So this big part of this market moving in the hands of asset managers was banks not wanting to be involved. Right. Now you have banks willing to supply leverage to you and also getting interested again in this business. How do you see the banks playing into the competitive landscape and the risk of banks even lending to direct lending funds going forward?
If I were working at a bank, I would be pulling my hair out saying, why is it okay for us to leverage these, lever deals, but we can't actually do these lever deals? But, I think it's treated as an asset-backed, risk, and look, it's all in the Basel III regs, and I wouldn't even pretend to be able to articulate to you why they're able to do that, but not sort of traditional stuff. But to your point, banks are very sophisticated. I think they've been struggling over the last handful of years as this asset class has grown, and they are trying to come up with solutions. And, we've met with a lot of the large cap banks. They're each sort of thinking about it slightly differently. They have, significant competitive advantages in that they have tremendous corporate relationships. They have historically great private equity relationships. I think the challenge for banks is to figure out how to navigate within the regs. And you're seeing some start to partner up with other direct lenders. You're seeing some start to raise third-party capital. I wouldn't count the banks out. I mean, they should and they will find a way to sort of, get involved in this business, but it's hard because they're not really able to take these assets on their own balance sheet. All the issues that we all live through during the GFC of sort of, I mean, they're muted today, but they still resonate, with banks. And I think, they've just got to figure out how to manage those dynamics, but they'll be back. I don't doubt it for a second.
All right, Ron, I want to make sure I get a chance to ask you a couple of closing questions. Okay. We started with your first paid job at EDS. What did you learn from that job?
When you join EDS, the first thing they do is they send you down to Texas for this, they call it the EDS training program. It's 10 or 12 weeks of really intense training, to sort of develop your skills. But the model for that training program is to sort of, challenge you from a multitasking perspective, from a resource constrained perspective. You'd go down there were 40 of us in the training program, and you'd have 8 hours of classroom training, and then you'd have the equivalent of 8 hours of project work to do. I mean, it was pretty intense. And I remember you'd come into class some mornings and a seat would be empty, and the instructor would come up to the front of the room and he'd very matter-of-factly say, so-and-so, has been terminated for performance reasons. And, I mean, the amount of stress, you right out of college, this is my first job, I'm away from home. Over the course of those 10 or 12 weeks, 22 made it through the program. I was reasonably convinced if, any day someone was going to tap me on, I was going to be the next one out the door. But I think what it taught me was we all underestimate what we're capable of doing, when put in really, challenging environments. And for me, I think to this day, that was probably the most difficult, 10 or 12 weeks of my career. I mean, it was, I so clearly remember how stressed I was and how difficult it was. But, when you come out the other end of it, you feel pretty good about yourself and you feel like you can pretty much take on anything. And so for me, it's just, I learned a lot about myself in that process and what I was capable of.
What's your biggest investment pet peeve?
As the market has changed, as so much capital has come in, deals move pretty quickly. And what drives me nuts is when people try to cut corners or take things at face value. Everything in our business is a sale, right? I'm selling you this is a good company, or I'm selling you should provide this kind of leverage. You can't take anything at face value. You got to do your work. And it's hard because things are moving in some cases at lightning speed, and it's easy to sort of, they like it at this leverage, so it must be okay. But, for me, nothing drives me crazy more than just you got to do the work.
Which two people have had the biggest impact on your professional life?
When I joined the Royal Bank of Scotland, there were two individuals that brought me on, and I worked with, their names were Leith Robertson and Ewan Hamilton, two Scots. And, when I joined RBS, I was just a deal guy, right? I had private equity relationships. I'd done a bunch of deals. And, they gave me the opportunity, they gave me a white canvas at the 5th largest bank in the world to build, a leveraged finance business in the US. And, the mentorship they provided, the guidance they provided, I will forever be grateful to them. That job changed the direction of my career. And, they were incredible bankers. They're still good friends today. And I can't say enough things about how grateful I am to them for giving me that opportunity.
What's the best advice you ever received?
My mom used to instill in us, be kind to people. And don't be kind to people because you're looking for something back in return. Be kind to people because it's the right way to be. And my wife and I have tried to instill this in our daughters. And look, I think in the world we're living in today, it's a pretty good ethos to live by.
All right, Ron, last one. If the next 5 years are a chapter in your life, what's that chapter about?
It's easy because it rolls off the last question you asked me. I've got two amazing daughters. They're teenagers. They're both going to be in college in the next handful of years. And so if the next chapter in our life would probably be entitled transition. We spent the last 17 years of our lives, my wife and I, worrying about them, supporting them, doing everything we possibly can for them. And I'm a little bit wary of what our lives are going to look like when they leave the nest and, we're looking at each other and our dog and trying to figure out what we're going to do next.
How about on the business side in the next 5 years?
It's continue to grow the platform. So what's the chapter going to be called? Gosh, I don't know. I don't know that it's a new chapter. I think it's just going to be a continuation of what we've been doing, which is, I think we will, massively grow to build a business from start, it's sort of like there's this trajectory, right? And it takes a while to sort of, get lift. We've just gotten to a place where we've got significant lift and significant inertia. And I think, if we start to see the market rebound in terms of M&A volumes, I think for us, maybe it'll be called explosive. I think we're gonna see some pretty explosive growth in our platform over the next 5 years.
Sure. Well, Ron, thanks for this deep dive into the senior secured space.
Thank you so much, Ted. It was great to appreciate the time.